we calmly organize the movements of the world and the flow of the markets. This is Moonvale Atelier's economic analysis. When people look at a move like this, the first instinct is usually simple. Oil goes up, stocks go down, end of story. But what makes this setup more dangerous is that it may not stop there. Because the real risk is not just higher oil by itself. The real risk is what higher oil can trigger next. Energy costs rise. Inflation fears come back. Rate cuts get pushed further out. Borrowing costs stay high. Refinancing gets harder. Weaker borrowers start to feel pressure first. And eventually, the market stops worrying only about price moves and starts worrying about liquidity. That is when things get more serious. So today, I want to walk through that chain clearly. The chain of credit stress that comes after higher oil. And when I say credit stress, I do not just mean a dramatic banking collapse. In fact, the more likely version is quieter than that. Private credit, leveraged loans, non-bank financing, smaller or weaker borrowers that depend heavily on refinancing. That is where stress can build slowly, but very dangerously. Today's structure is simple. First, why higher oil can lead to credit stress in the first place. Second, why oil alone does not automatically break the system. Third, what happens when higher oil collides with an already high-rate environment. Fourth, where the pain is most likely to show up first. And fifth, why a credit crisis may matter more than a banking crisis in this phase. Chapter 1. Why does higher oil turn into a credit problem? At first glance, oil and credit do not look like the same story, but they are more connected than they seem. When oil rises, transport costs rise, manufacturing costs rise, energy bills rise, households face higher living costs, companies face higher operating pressure. That part is straightforward. But the real market problem comes one step later. Higher oil can push inflation concerns back up. And when that happens, the interest rates that should normally fall during a slowdown may not fall as easily as investors hope. That changes the whole setup. Growth can weaken, but rate cuts get delayed. So the stress from high borrowing costs lasts longer. And that is exactly how oil starts feeding into credit. From the borrower's point of view, it becomes a very bad combination. Revenue growth is weak, costs are higher, and interest expense stays elevated. Once those three things line up, weaker borrowers begin to feel pressure first. That is how the credit chain starts. Chapter 2. Higher oil alone still has buffers. Now, it is important not to overstate this. Higher oil by itself does not automatically mean financial collapse. There are still buffers in the system. Strategic reserves can be used. Alternative supply routes can help. Governments can try to smooth consumer pain with temporary measures. Markets do have some shock absorbers. So this is not a simple story where oil spikes and everything immediately breaks. The real danger appears when higher oil lasts long enough to collide with a pre-existing high-rate environment. That overlap is what matters. An oil shock on its own may be absorbable. A high-rate environment on its own may be manageable over time. But when both happen together, the system loses flexibility. Because higher oil can keep inflation concerns alive. That delays rate relief. And delayed rate relief means financial stress stays in place longer than expected. That is when the real pressure begins to build. Chapter 3. Credit stress starts with the weaker borrowers. So where does the damage appear first? This is one of the most important parts of the whole story. In a setup like this, the first cracks usually do not appear in the strongest large-cap companies. They tend to show up first in smaller businesses, weaker private borrowers, lower quality credits, and highly leveraged parts of the system. That matters because markets often look at major indexes and assume everything is still holding together if the big charts look stable. But credit stress often begins somewhere less visible, not in the headline index, not in the part of the market people watch every minute, but in the borrowers with less room to absorb higher costs and higher rates. That is why surface calm can be misleading. Stocks can still look relatively orderly, while financing conditions underneath are already tightening in a much more serious way. Chapter 4. The most dangerous fragility may be in the less visible parts of credit supply. This is where the story becomes more important. Corporate finance no longer runs only through traditional banks. A huge amount of credit now flows through private credit funds, leveraged loan markets, CLO structures, non-bank lenders, and other channels outside the classic banking system. That changes where risk can build. Because in a shock, the most dangerous areas are not always the most visible ones. The real amplification can come from places where liquidity mismatches, leverage, and redemption pressure sit below the surface. And that is exactly why this matters so much. A lot of these structures look stable as long as funding is available and exits remain open. But once people start asking whether assets can really be refinanced, repriced, or sold without friction, liquidity can break faster than price. That is when markets get scared. Not just because prices fall, but because the exit door starts to look smaller than everyone assumed. Chapter 5. How does higher oil actually amplify credit stress? Now let's connect the chain more directly. It begins with geopolitical risk, shipping disruption, and higher insurance or freight costs. That feeds into higher oil and energy costs. Then inflation concerns rise again. Then the path toward rate cuts becomes less clear. And once that happens, borrowing costs stay elevated longer. That is the transmission mechanism. Credit does not need a dramatic headline to weaken. It just needs enough time under pressure. If refinancing stays expensive, if spreads begin to widen, if weaker firms have to roll debt under worse conditions, then what began as an oil shock quietly becomes a credit deterioration story. And this is why it is dangerous to treat the current setup as just another geopolitical headline event. Because under the surface, the financing layer may already be starting to tighten. Chapter 6. A banking crisis and a credit crisis are not the same thing. This is the final distinction I want to make. When people hear the word crisis, they often picture banks failing, deposit runs, or an immediate systemic shock. But what may matter more here is not a classic banking crisis. It is a credit crisis. Those are not the same thing. Banks can look stable on the surface, while credit creation outside the banking sector begins to weaken. Private credit can slow. Non-bank lenders can become more cautious. Refinancing channels can tighten. And once that happens, companies do not need a bank run to feel pain. They just need less access to funding. That is why the key question right now is not simply whether banks look fine. The better question is, where does liquidity start disappearing first? Where do redemptions, markdowns, refinancing stress, or gated exits begin showing up first? That is where the market may be giving us the real warning. Chapter 7. How should we think about this chain from here? So what matters most now? In my view, the key issue is not just how far oil rises. It is how long higher oil keeps high-rate stress alive, and then how far that pressure spreads into weaker parts of the credit system. That is what needs to be watched closely. There are 4 things I would keep watching. First, do oil prices stay elevated, or do they fade quickly? If they stay high, inflation expectations and delayed rate relief remain part of the story. Second, do high-yield spreads and broader credit indicators begin to weaken more clearly? That may look quiet compared with stocks, but it is often much more important. Third, do we see more signs of stress in private credit, non-bank finance, redemptions, markdowns, or defaults? That is where deeper fragility can appear. Fourth, do the slower real economy indicators eventually follow? Defaults, hiring weakness, investment slowdowns, business closures. Those are usually later, but they matter a lot. If those layers start lining up, then higher oil was not just a commodity story. It was the entry point into a broader credit stress cycle. Closing. So let's bring it together. Higher oil by itself does not automatically break the world. There are buffers. There are policy responses. There are ways to absorb part of the shock. But the real danger begins when higher oil collides with an already restrictive financial environment. Inflation fears come back. Rate cuts get delayed. Borrowing costs stay high. Weaker borrowers get squeezed first, and then, before the biggest price collapses even arrive, liquidity can begin to disappear. That is the chain. And once you see that sequence clearly, the title makes a lot more sense. The chain of credit stress that comes after higher oil. So the real question in this market is not just, how high can oil go? The deeper question is, how long can higher oil keep credit conditions tight? And where does the pressure show up first? Because if that process is already beginning, then this is not just a simple dip. It may be the early stage of a broader credit stress cycle. We should keep tracking it together.